because Alibaba remains a cornerstone of our portfolio with its leadership in e-commerce, cloud computing, digital payments. It's positioned for sustained global growth. It's available today for a huge discount to its intrinsic value. And as discussed last year, Alibaba is undergoing a major organizational transformation. They've decentralized the operations into 6 segments, and they have a diverse set of subsidiaries operating globally with values that are at least 50% higher than its current market price. And many of these businesses are growing. This last quarter, Alibaba repurchased $5.8 billion in stock, amounting to 2.3% of the entire shares outstanding. They just reduced those shares outstanding in a single quarter, and they have an initiative in place to repurchase more than 10% of the market cap because it's so undervalued before 2027. They're planning to spend another $26 billion of the $55 billion they have in cash to buy back shares from just a $200 billion market cap. So as these cash flows grow to 25 and 30 billion a year, Alibaba is selling for just 150 billion net of cash. It's going to be worth double what we're buying it for today. It's an incredible opportunity. Alibaba is currently undertaking one of the largest internal share repurchase initiatives in the world's history. They allocated 35 billion to buying back their company's shares. And when it's completed, Alibaba will have reduced its share count to below 2 billion, and we may be in a position to own 0.01% of the entire firm. The Baba earnings call was last Thursday. It was great to hear from Eddie Wu and management on all of their progress and their exciting AI initiatives. We are in a very strong period for Alibaba and these firms. But that's not all. As you may remember, we don't pay retail prices for our investments. This is our first example of structured value in practice. This shows how to buy a stock trading for over $80 for just $70 per share by selling a cash secured put contract. So we start by writing a put, and we receive cash from our counterpart. We would receive $20 in cash in this example. We commit to buying it for $90 over the next 28 months, and they have paid us $20. We hold $70 of our own collateral in cash, and we receive the $20 from them. And at expiration, they will either put the shares to us or they won't, based on whether the price of the shares are above or below the $90 strike price at expiration. So if the shares are above 90, we keep the $20 premium on our $7 in collateral, which is a 28% return, or approximately 1% each month for 28 months. However, if they remain below 90, we will buy shares at an extraordinary price of just $70 in December of 2026. So structured value allows us to buy more with less. It's a huge advantage.
Question from Krishna. He's wondering, how is Alibaba being held as a US stock or Hong Kong stock, and any rationale behind this approach? And there's also another listener wondering about, with the slowing growth in the Chinese economy and increasing debt and US-China tension getting even greater, how would that impact on your assessment on Baba's in the future?
Great. These are all great questions. So you may not love this answer, but we have derivatives on a VIE. So we have call options on the ADR, which is the VIE structure that gives us access to the ownership of Baba. All right. So we watch that quite carefully. There is a contractual relationship. We believe that the Chinese government requires capital markets. It would be very strange for them to sort of destroy things. Where the VIE structure could break down is possibly with a smaller firm, probably not with Baba. But if we saw that happening with a smaller firm, then we would question what would happen with Baba. So we'd probably see pretty far in advance, similar to hopefully what we saw with Seritage. So we noticed Seritage long before its real decline, and we were able to exit. So if there's something threatening the current structure, I believe that we'll see it quite early. Regarding the slowdown in China, it's tricky because oftentimes to find great value, you really have to go to where there's blood in the streets. So as a value investor, you have to sit there and look wrong for a long period of time sometimes before things start moving in the right direction. So you end up looking in places that a lot of people don't want to go. There are a lot of challenges with China. There's challenges with the GDP. There's challenges with the economics. And of course, there's tensions between the US and China. However, Baba is truly an international business. They are operating all over the world. Their earnings and cash flows are growing, and they're looking to exceed, 25 billion a year coming up here in a year or two. They'll be hitting that consistently. So if excluding their cash, their whole business is only 150 million, it's like 6 years until they bring in the cash that replaces the whole business. So we find it very unlikely that we will lose money on this Baba opportunity. Baba is truly a global player in the cloud space, AI space, and technology space. Baba, Tencent that we own through our Naspers position, along with Google, Amazon, Microsoft, and some of the big US players. These are the players, and we're so pleased to own a piece of it. And it's a global player. We think it should compete globally. We think in the long term it will be competing globally, and it should be priced globally. So right now we have the Amazons and Googles of the world trading for trillions, and Baba earning 20+ billion a year has recently been selling for under 200 billion. So this is a company that has a long runway ahead of it. Years ago, although Munger reversed his position, Munger started buying in for $200 a share. We've been buying in more like $80 a share. And we've been using our wheel strategy to buy in the money call options. So our exposure is right now through the calls. And the calls are actually quite volatile. All right. So we do see volatility in our portfolio, but these call options go out until December of 2026. So we have in the money call options that we've accumulated for very low prices. In some cases, they've been totally free, and we've packed our portfolios with these. We have call options right now on 200,000 shares of Alibaba. And our plan, because we don't have all the cash today to buy all of those calls. All right. So our plan, if we reach December of 2026, first of all, we may bring in that capital. We're raising capital every single quarter. We also have our structured dividend capture, which is generating cash for us every single month. So we may raise the money to buy that, but the ultimate plan is to use half of the calls that appreciate to purchase the other half. So it's the move that Buffett did when he was buying Goldman Sachs. He was reinvesting in Goldman Sachs in the financial crisis. He was investing in Bank of America. He was getting these warrants, and then when they expired, he would sell half, and he'd use that cash that he made to make the full purchase, and his stock ended up being free. So that's the method that we're using. If they buy back their shares and we buy our entire position, we will own 0.01% of Baba, which is absolutely astonishing. If Baba becomes $1 trillion business over the next 20 years, we will own $100 million of that business.
How wonderful. I love how you integrate value investing and Buffett's principles in your fund's philosophy.